the U.S. is no longer backed by manufacturing and an economy that's creating a supply chain that's creating.
No,
It's
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 not.
backed by
It
mania.
hasn't. It hasn't been since the 50s, really.
Yeah, it's
Right?
we've been
Or
slowly disconnecting from that. And
yeah.
every time you get something like the 2008 great financial crisis, what we just had with 2020, every time you get that and they have to go and print trillions of dollars, you diverge further and further away from an economy and a GDP that's producing. You become a GDP that's based off of equity prices. And that's what we see right
Correct.
now.
And consumption and whatnot.
Yeah, like there's some concerning data. Like let's jump into this. I think we get the inequality stuff. We don't need to harp on that. But right now, through 2021, it was interesting. The data started releasing in March, and I didn't really pay attention to it. And I just went through all my notes yesterday and put it all together. But in March is when they started talking about this. So March of 2021, and they talked about the fact that real assets relative to financial assets were at its lowest point since 1925. So let me define this. Real assets are commodities, real estate, land, ships, boats,
Non-speculative
shipping
assets.
containers. Yeah, all the good real stuff, right? And then financial
Durables and shit.
assets, yeah, financial assets are stocks, bonds, yields, and even cash, right? And so what that means is that real assets were at the lowest point as in terms of proportion of holdings for the consumer since 1925, and financial assets were at the highest. And it got up to, by October, it was almost 42% of people's money was in equities. That's concerning. So here's
That's
that chart.
ridiculous.
Here's that chart right here.
So ridiculous.
So 41.5% of money sat in stocks.
So what this is okay, so this is like sentiment check, monetarily
Yes.
speaking, right?
Yes.
Because this
Macro
is
sentiment check.
hell yeah, because this is mom and pop at home. This isn't the
Yeah.
institutions.
Yeah. Yeah. This is retail. This is
Yeah,
dumb money.
correct. So that's an important distinction to make here because it does matter,
Yeah,
right?
and
I mean,
so why it matters is because we talk about rug pulls, right? So now
hmm
imagine this. We've got most people, they got 41% in equities. But what's going to happen after this first rate hike, they just announced it, is on the last Fed minute, is that they're most likely going to start dumping their positions, their bonds, their yield positions, everything that they've been buying up, the Fed has been buying up right after this rate hike. And the rate hike is expected in March. So now
yeah,
imagine this: March comes along, they do a 25-point base jump, right? That's probably what they'll do. And so they do the rate hike, and then they start cutting their balance sheet, their books. They start, selling off all their positions. But you're still holding 41% in equities. So
right.
now that nice fat household net income that's gone up, that net worth that's gone up
Just
through
dissipated.
the last year is gone. That's the equivalent of rug pull in crypto, but that's in equities.
Correct.
And you'll never see this coming because most
Nope.
people aren't paying attention. We could be screaming this right now consistently all the way until March when this first rate hike happens, and most people will not listen.
Yep. I mean, I've been talking about this since last year, bro. Literally since I started streaming, pretty much. Been talking
Yeah.
about all of these things, about how the macro environment is just positively structured for an investment in Hex. Like all of these things are positive for Hex. This is a funny thing.
Yeah, it is.
So while everything else is literally burning to the ground, just like always, Hex.com user unaffected. And that's just the name of the game. Because when you're a high yielding, capital gaining, capital appreciating asset, excuse me, you have a reason to exist. People have a reason to buy you. Right? And this is something that's important for people to realize. Now the only question then becomes, well, does the owner still want to own the asset or do they want to go play in somebody else's sandbox, right? Because you can't help people understand the math. They just got to understand there is math.
Yeah.
So,
Yeah, absolutely. So now picture this. This is all happening, right? And then Bitcoin will probably follow because it's been following, equities.
yep.
So Bitcoin, ETH, and all the primaries follow. But yet we're going to play the floor is lava game day after day after day after day after day after day, and Hex is going to be green. Imagine
Pretty
that
much.
scenario. How
Pretty
is that
much.
for onboarding?
Pretty much, it's gonna make it real easy.
It's gonna make it real easy. Just seriously take a screenshot of that, that heat map every single day and just mass text message it to everybody you know. There you go. There's your onboarding for the day.
Done.
You want
to ride this train or what?
Exactly. So check this out. Inflows into equities exceeds combined inflow of the past 19 years based on a 12-month rolling average.
Wow.
Repeat
that.
Okay.
Yeah, because that's pretty profound.
Inflows into equities exceeds the combined amount over the last 19 years.
Wow.
Like, that is stupid.
Mm-hmm.
That is like something you go meditate on.
That's ridiculous.
Yeah.
That is ridiculous. Wow.
Okay. So, now going back to what we were just talking about, do you think we have a problem?
Yeah.
I would say yes, we've got a problem. Because here's why.
A little bit overstretched. I'm liking long-term put leaps here.
Yeah. Oh, no kidding. Hey.
Yeah.
So why is this a bad idea? Can we actually tell if stocks are overvalued or undervalued right now? I'm going to give you just two indicators that you could use. You could use others, but we're going to talk about Shiller PE ratio, which is just price to earnings ratio model that tends to be pretty accurate. And so here's how it works. The higher this number, which right now is at 39.28, the higher this number, the more overvalued the S&P index is. Now, if we look back left, we've only got one other point when it was higher, right? And that was the 2000 tech bubble. So we're literally sitting just below all-time highs on this PE ratio, which tells us that we are paying the highest possible premium for these equities. So you tell me, is now the time to be buying for a 10-year, 20-year outlook investment? Fuck no.
Probably not.
But to trade this, again, we're talking different time frames, different games. To trade this, cool, different conversation. But to go park your family's money in this for the next 20 years, probably not. Probably not. I mean, you got to think of it like this. Like, is it going to kill you to see how this plays out by March? To see how this first quarter plays out? No. I mean, come on.
Of course not.
There wouldn't be that much fluctuation in how much you're able to purchase with your money. So, I mean, it'd be in your best interest to at least wait, right? And see how this all shakes out. Another piece to add to this is, I actually don't remember who made this piece of data. It's not tagged or anything, but right now, the multiple of how many years it takes to get paid back on your equities is at around 22 years. So that means your ROI, you're not going to get shit until about 22 years out. And this is because the valuations are at such a premium right now.
Right.
And you've seen this. This has been happening. This isn't brand new. This has been happening the entire pandemic. So if you look, every time this is peaked, it also coincides with what? A recession.
Mm-hmm.
And, I'm not trying to get doomy and gloomy. I'm just sharing data. So you can take whatever you want with this data. So the data is just telling you what the fuck it's telling you. And it's telling you, if we look at every single time that it got up towards this black line, that it coincided with a recession. Thank you so much. Thank you so much for the dono. Appreciate that. Oh, man, I think that's the first dono we got on the show.
Probably,
Hell yeah. Thank you.
Thanks,
Thank you,
Brian. You're the man.
It means a lot. It means a lot for you guys to support us, the DS channel. We do what we can with what we got. And so every little bit helps. Okay, so it gets a little worse here, though, because now if we continue to look at the rest of the assets that are represented as financial assets, right? We talked about this: bonds, cash,
stocks,
treasuries, stocks, right? So here we got real bond yield, nominal bond yield, and this circle is saying worst yet, worst ever. Real bond yield, nominal cash rate. So right now you're getting the worst possible rates. And you've seen this, though. You're getting the worst possible rates in high interest yield savings accounts, CDs, bonds, yield, treasuries. You're getting the worst rate on just about everything right now.
Everything.
But while that's happening, simultaneously, equities are accounting for 181% of GDP right now. Let me say that one more time. So equities right now account for 181% of GDP. So we're starting to piece together this narrative, right?
Right.
And the narrative is telling us that right now is a very expensive time to buy equities, but yet everyone's buying equities. Kind of
Typically
interesting,
how
right?
it works. Typically how it works.
Because what does retail always do? Buys the top.
Yep. They always come
And
in late.
and we can look at this. We can look at this in terms of personal savings rate too. I got this.
All
Let me
right.
just show
Personal
this.
savings rate is depressed, actually. Yep.
Yeah. So here's this right here. Let's zoom in on this because this is actually just image that I got. So okay. So here's our trend line, and we're sitting just below that trend line, and that trend line is about $800. So here's our first stimmy check right here. Bang. We got that, and personal savings skyrocketed. Here's that second stimmy check beginning of 2021, and then here's where we are now.
No more stimmy checks to be accounted.
No more stimmy checks. Those are gone. And then, so we want to check in on, okay, so what's everyone doing now, right? It gets a little worse if I'm being honest. So what's everyone doing right now? Well, it would appear that they're opening up new credit cards. So revolving consumer credit, that is anything that reports as a revolving credit line on your consumer credit report. And as you can see, it's at 19.8, which is a record high. Going back to, I think going back to data in the 80s, I think it lines up with somewhere in the early 80s because we had another big surge back then. But like over the last 20 years rather, it is at the highest it's ever been. So what do we see? Personal savings rates are at all-time low. Stimmy checks, extended unemployment benefits, all gone, all done with. And so where do they go? Well, they go to revolving credit to get more extension, to get more credit. Because, most of the US economy, people don't realize this is, it's based off cash, but it's mostly based off credit. Like credit's the easiest producer of economic energy is because all it requires is me and you to come together, sign a piece of paper. I get something from you or you get something from me. We sign on a dotted line and that's it. Boom, credit has been created.
Yep.
So the amount of cash that's in circulation versus the amount of credit is like 100-fold. Most of the US economy is based on credit, even though they're both accounted under cash.
Correct.
Right? So
Most of it.
Yeah. Interesting to note, right?